Do you know about consensus estimate, definition, how it works, and example? Sit right there. What is a consensus estimate? In the realm of finance, a consensus estimate is a collective forecast of a company's financial performance. Typically, it's earnings per share, EPS, or revenue, based on the predictions of multiple financial analysts who cover that company. It essentially represents the average expectation of these analysts regarding the company's future financial results. Of course, you're curious on how it works, yeah? Here for you. Analyst forecasts. Several financial analysts employed by investment banks, research firms, or independent agencies conduct in-depth research on a particular company. This research involves analyzing the company's financial statements, industry trends, competitive landscape, and overall economic conditions. Based on their analysis, each analyst publishes their own forecast for the company's future earnings or revenue. Aggregation of estimates. Financial data providers such as Refinitiv, FactSet, and Bloomberg collect these individual analyst forecasts. They then aggregate these estimates, typically by calculating the average or median, to arrive at a single consensus estimate. Dissemination of the consensus estimate. The consensus estimate is widely disseminated through financial news outlets, investment platforms, and research reports. It becomes a crucial benchmark for investors and traders to gauge market expectations for the company's performance. Well, formula for calculating consensus. EPS is simple. Consensus EPS equals sum of all forecasts divided by number of forecasts. So for example, let's say 5 analysts provide the following forecasts for company XYZ's earnings per share, EPS, for the next quarter. Analyst 1, $2.5, Analyst 2, $2.75, Analyst 3, $2.6, Analyst 4, $2.45, Analyst 5, $2.8. In this case, we have just 5 forecasts. We will add it up and divide it by 5. Am I clear? Which is $13.1 divided by 5. The consensus estimate here is $2.62. Do you understand? Okay, now why are consensus estimates important? When a company reports its actual earnings, investors compare the results to the consensus estimate. Beating the consensus. If a company exceeds the consensus estimate, it generally signals strong performance, which can positively impact the stock price. Investors use consensus estimates to evaluate investment opportunities. They may use the estimates to assess whether a company is undervalued or overvalued relative to market expectations. You must also observe some key considerations. Accuracy. Consensus estimates are not always accurate. Unforeseen events or changes in market conditions can significantly impact a company's actual performance. Analyst bias. Analyst forecasts can be influenced by various factors, including their own investment positions, relationships with company management, and overall market sentiment. Limited scope. Consensus estimates typically focus on a limited set of financial metrics such as EPS and revenue. They may not fully capture all the factors that can impact a company's long-term performance. To wrap it up, consensus estimates play a significant role in the financial markets by providing a common framework for evaluating company performance and making investment decisions. While they are not infallible, they offer valuable insights into market expectations and can be a useful tool for investors, analysts, and traders.